Yeah, it's a very good question. I mean, look, we are inherently bottom-up fundamental analysts. We basically pick stock based on fundamentals. Having said that, for the last, really since the GFC, and we've been in a very macro-driven market, and it would be foolish not to have an eye to what is going on globally, and that can have ramifications for thematics, it can have ramifications for interest rates, housing cycles, and so on. So, look, we do take that on board, but we do stick to process and look at, you know, Australia in isolation as where we see value. But there's no doubt you've got to look at the macro trends as far as what's going to happen on the rate cycle and what that will mean ultimately for equities as an asset class, because clearly we've seen some stocks re-rate materially in the last 3 years, and naturally these have been stocks that have high growth. You know, they have offshore earnings, or, you know, in some instances cyclical stocks in the last 2 years, and we need to be very conscious of what a big change in interest rate settings has for these stocks. However, as I said before, we do think you know, any rate rise by the Federal Reserve is been very well telegraphed, and if they were to surprise early, you know, maybe we get something in the March quarter. I think more short term there's some risk around the next Fed meeting in September, because we're approaching the final withdrawal of QE in October, and I think the market's dying for more colour and commentary from Janet Yellen on exactly when she and what the forward guidance in verbiage as to when she's going to raise interest rates, and I think the market is needing that, so I think she'll be forced to say a little bit more, and I guess we'll have to wait and see how the market deals with that. But as I said, we remain relatively comfortable as it stands at the moment that the market's consensus view is there or thereabouts.